This is your Lead Left Vodcast for the week of December 5th. I'm Randy Schwimmer. Welcome back. As a long-term principle in the credit markets, we've learned the most intriguing times are not when things are going swimmingly for issuers or investors. Life becomes interesting when trends begin to shift at the inflection points. These are often apparent only in hindsight. The Great Recession, for example, ended in June 2009, barely 6 months after the rescue of General Motors and Chrysler. Yet it wasn't officially announced by the Business Cycle Dating Committee of the National Bureau of Economic Research until September 2010. And predictions are tricky. Calls for the next recession have been numerous and wrong. Signals like an inverted yield curve have turned out to be premature. Tied to economic fortune is the direction of interest rates. Both cause and effect of business prospects, rates were headed sharply up last year, until the market's surprise tanking in November led the Fed to hit the brakes and reverse course. Seemingly out of nowhere then, strong third quarter corporate earnings has pushed public equities to record heights. Further rate cuts? Not likely. All this head-snapping change has again changed the conversation about private credit risk. What are investors to make of it? Well, first, being a floating rate asset class, middle market loans are a hedge to rate moves. Second, while terms and structures have weakened, sustained economic growth lifts all issuers. Finally, a recession reprieve does not mean a reversal. Experienced direct lenders are closely monitoring their exposure to cyclicals. It's also time to think about dedicated workout teams. No coincidence that credit managers, prompted as well by investors, are looking for restructuring professionals. Expertise that's gone untapped for a decade is now in high demand. Being alert for inflection points doesn't mean you'll recognize them. Good credit managers don't change strategies with every treasury move or ISM data blip. All-weather risk management means applying consistent credit standards in every cycle. But being aware of subtle changes to market technicals resulting in spread widening or leverage tightening can benefit investors until the next inflection point. From the Business Cycle Dating Committee of the National Bureau of Economic Research Office at the Lead Left, this is Randy Schwimmer. Thanks for watching and have a great week. Business Cycle Dating Committee of the National Bureau of Economic Research. I wonder what their office sign looks like.